For every business, it's very important that they are able to evaluate their own performance, they're able to reduce the damaging activities, and to compare themselves to their competitors. For all of these, what businesses use are ratio analysis. Ratio analysis does not just help them evaluate their own business, but also helps them evaluate their suppliers, customers, or competitors. So in this video, I'm going to talk about 6 of these common ratio analysis that you should be knowing about. So I can do others in future video. Let me know if you want me to do that. So the first ratio is the sales growth. Sales growth is taken by sales for the period divided by sales for the previous period. So the shorter the time period, the more sensitive the ratio is going to be, and shorter time periods are most suitable for reflecting seasonal demand. The second ratio, the market share ratio. Now, in highly competitive situations, the sales growth should be read alongside the market share ratio, which is basically the current market share over the previous market share. Also, keep in mind, if the market share is being taken with the sales growth, then the time periods need to be similar. The third ratio is the debtors to creditors ratio. So this ratio shows a relationship between the credit given to the customers and the one taken from the suppliers. So it's simply credit given over the credit taken. The fourth ratio is the quick ratio, also known as the acid test ratio. So this ratio is used to measure the liquidity of a company, which is basically meaning how quickly a company can change its assets into cash. The most common way to calculate this is to subtract the inventory from the current assets and dividing it by the current liabilities. And keep in mind, the healthiest ratio to have is a 1-to-1 ratio. The next ratio is the stock turnover ratio, which is basically stock value divided by average daily cost of sales. The stock turnover ratio shows for how long cash is being tied up in stock. The quicker the stock turnover is, this means that the cash is being used more efficiently. The last ratio I'm discussing is return on equity. Now, it's very important for a business and for the investors to know how much money a business can make for its investors. So this is calculated as net profit after tax over the equity capital, and obviously investors pay considerable attention to it. Now, there are many more ratios like profit vulnerability or break-even ratio. I might discuss this in a future videos. If you have any other suggestions or ideas, write them down in the comments section. Bye-bye, that is all for now.